All right, so let's get started and jump right into things. Welcome, everyone, and thank you so much for joining us here on our webinar. Just to introduce myself, my name is Jonathan Brandeo, and I am the Director of Learning and Development here at MLB. And today I have the pleasure of presenting a webinar all about manual underwriting, talking about what it is, when it is required, and how it works across your FHA, VA, and USDA loans. Now, manual underwriting is one of the things that's the most misunderstood piece of our industry. Many people assume that if a loan has to be manually underwritten, that automatically means that there's something wrong with that loan, something wrong with that borrower, and that's really just not the case. It's really just simply, instead of relying on an automated underwriting system like your DU, LPA, or Gus with USDA, the loan needs to be evaluated directly by an underwriter who is going through and viewing that borrower's full financial story. So, a lot of the times when it comes to a manual underwrite, it allows you to approve a borrower and move them to those final steps in the cases that an automated underwriting system may not allow. So, create some other opportunities to assist those borrowers and kind of move to those next steps. That's where manual underwrites become an incredibly powerful tool for you and for the partners that you're working with. So when you fully understand what manual underwriting is, it allows you to help the borrowers who other people might have turned away. And when you're doing that, you're not just closing a loan, you're helping families achieve home ownership or lower the stress of those cases of a refinance when they need to get into that kind of bucket. At the end of the day, our number one mission here at MLB is making lives better. And that's where manual underwriting is one of those tools that really help that and across all the partners we work with. So let's jump right into things, talk about the world of manual underwriting. Of course, if you have any questions as I'm making my way through, put those into the chat box. I'll also leave a little bit of time at the end for any questions you may have once we've gone through the presentation. And just to kind of as a heads up as well, you can always access the PowerPoint slides that I'm using today on our website just by going to mlbwholesale.com. Under resources, there's a section called videos and presentations where you can find all of the presentation slides for not just manual underwriting, but all of our other specialty programs, along with a link to our YouTube channel where you can find all the different videos of our different webinars, including manual underwriting, that you can always use as a great reference tool as you continue to grow your partnership with MLB. And of course, you also have the live assistance of your assigned account executive anytime you have questions about your partnership with us, whether that be a program, a system, and anything in between. So let's jump in and talk about manual underwriting. So, basic question here. What is a manual underwrite? So, starting with the bare bones basics. So, it is a process where that underwriter personally evaluates the borrower's ability to repay the mortgage. So, instead of relying only on your automated underwriting systems, the underwriter is going to go through and manually, as the name entails there, review several key areas of, once again, that borrower's story. So we're looking at the borrower's credit history, the income stability and employment, assets and reserves, their overall payment history, and just financial behavior for that borrower. The goal at the end of the day is to determine whether the borrower demonstrates the ability and willingness to repay the loan, even if an automated underwriting system could not issue that approval themselves. The most important thing to communicate to a borrower early is that a manual underwrite does require additional documentation and additional processing time. So it may take a little bit longer to move a loan from A to Z when it comes to a manual underwrite compared to those loans that automatically get that approval through an automated system. So always set those proper expectations and allow the underwriter to have that time to do a deeper review because they may ask for that more documentation than what would be normally required. But the benefit here is that manual underwriting allows us to look beyond the credit score, to look beyond a algorithm of an automated underwriting system and be able to fully evaluate that full borrower's financial situation. So what are we looking for when it comes to a manual underwrite? So what happens here is that a manual underwrite will come into play. Traditionally, the most common way that you're going to have that is if your automated underwriting system issues a refer finding. So you go in there, traditionally you get an approve eligible. Approve eligible lets you know, okay, we're good to go. You have the full approval through the automated underwriting system based on all the facts and details around that borrower and their situation. Now, let's say those findings come back as a refer or something similar to that. That means that the system could not automatically approve the file, so the loan must be reviewed manually by an underwriter. There's other scenarios other than that AUS issuing the refer. The second scenario would be if it's downgraded by the underwriter themselves. So the underwriter looked at the full file, even if we have an approve in our automated, and the loan has to be downgraded for one reason or the other. That's up to underwriting discretion. So that can be based on certain types of risk factors, such as limited credit history, significant credit events, certain type of payment patterns that the underwriter sees, or other types of guideline restrictions depending on which agency you're looking to go under. And then the third scenario would be if the actual loan program that you're using requires a manual underwrite. There are some programs out there that always require a manual underwrite. No matter what the system comes back with, that borrower has to do a manual because that's just the guidelines for that specific program. So that's something that's your third scenario. But like I said, your most common reason for using a manual is going to be that refer findings in the AUS. But the other two are very common scenarios that can come into play as well that would bring us into the world of a manual underwrite. So the first one we're going to talk about is FHA, the most common and the most used of these kind of different options here. So FHA allows manual underwriting if you don't get that approve eligible, if you get that refer. Now, the great thing about FHA and why it's such a powerful program is that it allows for lower credit scores than most other programs. So for a manual underwrite on FHA, we can go down to a 500 credit score. Now, dependent on where that FICO is located, will determine on where your LTV maxes are going to be. So you can see there is that if your score is at or below a 579, you're going to have a max LTV of 90%. So you're not going to be able to go over 90% if your score is lower than a 580. You're also going to have a max DTI of 3143 if your FICO is in the lower range of FICOs. Now, if you have a borrower with a higher FICO, so anything that's over a 580, so those over 580 scores, you can use the full FHA all the way up to the 96.5% LTV. So that's the biggest thing there is that the higher the FICO, the closer that manual underwriter is going to be to traditional LTVs on FHA. FHA does allow you to go up to a 50% DTI cap as long as you have additional compensating factors for that borrower to allow for that higher DTI range. From a payment history standpoint, you're going to notice as we talk about each agency is that payment history wise are very similar. There's slight differences for each agency, but it's very similar to what all of these manual underwriting guidelines are really looking for. We want zero lates over the last 30 days, over the last 12 months. So in the last 12 months, the last year, there are no late payments, no housing or installment late payments. When we're looking at months 13 through 24, so year number two, there's no more than two late payments in the last 2 years. So no late payments in the last year, and the maximum of two late payments in the full 2 years that the manual underwrite is always going to be looking at. When it comes to any type of revolving payments, it is a maximum of two late payments in the last 12 months and a maximum of 90 days on any types of delinquencies. So keep that in mind when it comes to FHA specifically. Now, when it comes to this piece as well, a biggest part of FHA manual underwriting is your housing history. The underwriter has to verify that the borrower has been paying their housing obligations as agreed upon. So what's going to happen here is that if the borrower is renting, we're going to need a verified rent history, which includes any of your canceled checks, bank statements, and even a verification from the landlord if necessary. FHA also has specific seasoning requirements when it comes to major credit events. So, for example, your Chapter 7 bankruptcy requires 24 months since the discharge date. Now, when I talk about each of these credit history items, and we're talking about FHA, the big piece here is your FHA case number, and it's based around when that FHA case number has been assigned. So if they have a Chapter 7, a Chapter 13, a foreclosure, any of those items, that case number cannot be created until we've hit the seasoning period uh, based on the discharge date. So that's a big information to get up front is that if a borrower or somebody that's part of the transaction lets you know that they were in any type of foreclosure or bankruptcies, the next question you should be asking is, what is the discharge date? Then from that actual date, then we actually count, and it has to be, so for example here, Chapter 7, 24 months. So the creation of that case number cannot be until 24 months and 1 day. So it has to be one full day after the 24 months. Same thing applies for a Chapter 13, 12 months and 1 day since the discharge date. FHA does allow a little bit of flexibility on a Chapter 13. It can be an open Chapter 13 as long as it has been open for longer than a year. So it has to be a full 12 months and a day that it's been open, and it has to have special approval from the trustee that's associated to that Chapter 13 under FHA guidelines. And then if there's any types of foreclosures, it has to be 36 months in a day until the case number can be created based on the when that foreclosure date happened. So that's a big kind of piece there is making sure that we have fully passed those seasoning periods before the case number is allowed to be created. And once that case number is able to be created, that means we're good to go and we can successfully move through the process smoothly without having any of those hiccups come up later down the road. A great helpful aspect of FHA is that family gift funds are allowed, which can allow a borrower who may not have any large savings for a down payment, and allows them to kind of really help out and help them rebuild their credit. Some other items to call out here on the FHA credit history side of things. For the last year, just to reiterate here, there cannot be any late payments in the last 12 months for housing and installment payments. Revolving, once again, a max of 2 late payments in the last 12 months, but no 90-day plus lates. And then, of course, if we're looking at year number 2, months 13 through 24, there can't be any more than 2 late payments. And revolving does allow for lates on that year number 2. But of course, the underwriter is going to look at the loan in detail, and they may ask for additional documentation, explanation on any of those items as they review the file and the borrower's financial situation. The biggest thing here is that the underwriters are really looking for improvement and stability. That is what an underwriter is going to be comfortable giving a clear to close on a manual underwrite, is seeing that borrower has improved their situation and they're stable moving forward once we're going to be able to close on this particular loan. So if the borrower's had credit issues in the past, but they've been able to demonstrate responsible behavior over the last 2 years, that manual underwriter is going to go in a much more positive direction. I mentioned earlier that your DTI limits can increase on FHA as long as you have additional compensating factors. Here's a chart to give you some examples of what those compensating factors would be to allow for the higher DTI ranges. So traditionally, if you talk to most people, if you ask them what is the max DTI on an FHA manual underwrite, if you Google that, it's probably going to come up 3143. So 3143, that's the rule of thumb. That's what most people are going to tell you is going to be the cap on all of your FHA manual underwrites. However, FHA does allow for the flexibility based on those compensating factors to go up to a maximum of 50%. And the number one factor is higher FICO scores. The higher the FICO score, the more likely they're able to get into the higher DTI ranges. On top of those higher FICO scores, anything that's above a 580, it's based on, do they have additional reserves? Do they have, can they document residual income? Can they show that they have no discretionary debt? Whether it be one of those things or multiple of those things. So, for example, here we can go all the way up to a max DTI of 40, 50. So 40 on the front end, 50 on the back. If we can document two things, if we can document they have residual income, we can document that they've have a minimum increase to housing payment, they have verified reserves, they significant additional income is not reflected in the effective income, any of those things. If two of those things are met, we can go to the maximum allowed on FHA of that 40/50 on the DTI with that 580 plus score. So you can see, just give you an example, is that those compensating factors, they're going to come in a good play here to really help strengthen the borrower's ability to move smoothly through an FHA manual underwrite. All right. So that's FHA. Let's jump over to VA. Like I mentioned, there's going to be some things that are similar on each of these, but we'll talk about kind of things that stand out separately here. Now, VA manual underwriting works a little bit different in FHA. So VA focuses less on they focus less on the rigid ratio limits, and they focus more on residual income and financial stability. Great thing here is that for your veterans that are eligible, they can actually get a full 100% LTV still. So 100% LTV is still acceptable as long as they have their full VA eligibility. They can go to a 500 minimum credit score. There are no housing, as long as there are no housing late payments in the last 12 months. So we're going to be looking at the last 2 years on all of the manual underwrite options. So the underwriter is always looking at 24 months, but the biggest thing is no late payments in the last 12 months. So the last 12 months are really the most important because that's the closest to our loan, but we're looking at the full thing. We have to show that they have verified housing history over the last 2 years. There are no collections in the borrower's name in the last 2 years. Big thing that is different here is VA always requires at least a minimum of 1 month of reserves. So 1 month of reserves always required on a manual underwrite on VA specifically. Residual income must always be met on a VA loan. So residual income measures how much money the borrower has left after they've paid off all their debts and housing expenses. So that's something that has to be met in order for VA to allow this to be a viable manual underwrite and allow that loan to close. So like I mentioned, VA typically requires at least 1 month of reserves, no collections in the last 24 months. They have to show a 2 year employment history. And like I mentioned, the biggest piece here is VA has an extremely strong emphasis on the financial stability of that veteran in the case of this type of borrower. From a DTI standpoint, most most lenders cap the DTI on a VA manual underwrite at 50%, but VA does allow a little bit of flexibility in there. So there can be situations where our underwriters here at MLB will allow for a DTI that's even over 50% on VA specifically if we have those extremely strong compensating factors. But it's all based on underwriting discretion. So that's something to keep in mind. It's up to that individual underwriter after looking at the full picture of that borrower's financial situation and if they will allow something to go into those higher DTI ranges on VA. Some examples of those factors include additional reserves on top of what VA already requires. So remember, VA requires 1 month. If they have multiple months of reserves, that can go into play for those compensating factors. If they have an LTV that's lower than 100%, if they're putting more money down out of their pocket, if they have good residual, more than double what is required on the basic terms on VA, they have excellent credit history, and they can document long-term employment. Those are just some examples. Those aren't everything. You can actually check out Chapter 4 of the VA Handbook to see specifically some more examples that VA would accept to increase the DTI based on the compensating factors. But just want to call out that, remember, FHA 50 is the absolute highest. You can't go higher than 50%, even with the compensating factors on FHA, but VA allows the flexibility to go higher if we have those compensating factors and the underwriter agrees that those compensating factors are something we can actually use and are comfortable with moving forward. An extremely important piece of VA as well is the letters of explanation or LOEs. Now, VA always requires a letter of explanation on all manual underwrites. FHA and USDA do not require the letters of explanation unless the underwriter determines that it's something that's necessary in order to give everyone who reviews that loan a full picture, the ability to see the story. So no matter whether you're the underwriter, you're the loan officer, you're the processor, whoever you are in that process, if you read that LOE, that gives you a full picture of what's happening in that borrower situation. So VA always requires it, but the things I'm going to break down here, these are kind of, in my opinion, the best rule of thumb whenever you ever need to do a letter of explanation. So whenever you have a conversation with a borrower and you need to do an LOE, use VA's breakdown of what they need because that will help you have a nice, clean LOE that not just MLB will accept, but pretty much anybody you work with will accept. That because you're going to have a great document that allows anybody to look at that file a full ability to understand what's happening here. So whenever there's any type of derogatory credit accounts, the borrower must provide that written explanation to address three things, and these three things must be met. First off, what caused the issue? Second, how was the situation resolved? And third, why will it never happen again? The goal here is for the underwriter to understand the borrower's circumstances and whether the issue was just something that's temporary or something that might be part of a larger pattern that may pop up again in the future post closing on the loan that we're currently working on. So acceptable explanations include medical events, temporary job loss, and in the case we're talking about VA right now, also includes military related stressors or deployments. So those are situations come up that are specific. Any type of vague explanation is not going to be sufficient. We need these to be as detailed as possible. We need the borrower is the one who's actually writing these letters of explanation. We want them to be clear, specific, and also be supported by documentation if the underwriter conditions for additional documentation to go hand in hand with that LOE to fully document and kind of go along with what was discussed in there. An extremely well-written LOE can make the big difference between an approval and unfortunately that loan not being able to move forward. So the more detailed your borrower is in writing these, the more likely you are for a successful approval and continue to keep things moving forward without having those roadblocks pop up of additional documentation requests or asking the borrower to go back and rewrite it and provide more detail. Like I mentioned, VA always requires this for a manual underwrite, but the way that they kind of structure it is a great way to keep in your brain any lender that I work with that needs an LOE. This is my best way to have explain to a borrower what we need to do because that will help me be able to move from A to Z much faster because I know, okay, this is exactly the best way to write a letter of explanation. So that's VA. That's all your VA items there. The last item I'm going to talk about here is USDA. And the thing with USDA is that this is the only slide I have. I only have one slide on USDA because it's pretty straightforward, easy, and it pretty much kind of very similar to how we talked about FHA at the beginning of today's presentation. Now, with USDA, they use the GUS or Guaranteed Underwriting System, GUS. If they get a refer or refer with caution, that's when a manual underwrite would come into play. USDA has the highest FICO requirement, so it's a 550 minimum for USDA. They have a max DTI of 3441. So even with compensating factors, USDA has that cap of 3441. So keep that in mind. You can't go any higher than that on USDA. For any type of late payments, you can't have any type of lates. whether it be housing, installment, revolving, all of that, no lates at all in the last year. So nothing in the last 12 months. No collections or charge-offs in the last 12 months. If they have any types of tax liens or judgments, they have to be 100% paid off, or we have to fully document a formal plan for that borrower. And then when it comes to Chapter 7, Chapter 13, and your foreclosures, those need a full 36 months from discharge date before they're eligible for USDA financing. So keep that in mind as well. So USDA has a higher FICO requirement, has a higher seasoning requirement when it comes to your bankruptcies and foreclosures, and additional kind of restrictions, which kind of goes hand in hand with just the way that USDA kind of structures their programs and based on the borrowers that they're looking to kind of fit into the eligibility of a USDA loan. So those are kind of all the pieces there when it comes to all the different types of manual underwriting options that we offer here at MLB. Now, of course, if you guys have any questions based on what I discussed today, feel free to throw those into the chat box. Feel free to unmute yourself if you're comfortable. But the biggest thing I want you to take away today is that manual underwriting isn't just about risk. It's understanding the full story behind a borrower, trying to figure out exactly credit behavior, financial stability, the borrower's responsibility as a homeowner, and those compensating factors. Because for you, this knowledge is extremely valuable because when you understand what a manual underwrite does, it can help you kind of really go through there and help those borrowers that maybe other people have turned away. Once again, our mission at MLB Wholesale is extremely simple. We're here to help you find solutions for your borrowers. It's not just about what the rate is, what these type of pieces are. It's solutions for those borrowers that others have turned away, ways that you can build relationships and grow those relationships of being a trusted advisor. And hand in hand, expand your pipeline. Every time we help a family achieve home ownership, we're doing exactly what our mission is, making lives better.